Welcome to 3 and 3. Today we're going to be talking about defensive stocks, duration, and worldwide interest rates. So defensive stocks. Defensive stocks provide consistent dividends and stable earnings regardless of the overall state of the stock market. Companies in these sectors provide goods and services that consumers continue to purchase and use regardless of whether times are good or bad. Those sectors are utilities, consumer staples, and healthcare. Company examples would be Procter & Gamble, Johnson & Johnson, Philip Morris, and Coca-Cola. In 2022, when the stock market was down about 18%, you can see that the performance of those defensive sectors did very well. Utilities were actually up about 1.4%, healthcare was only down about 2%, and consumer staples were down 0.8%. As we look at the chart up to 2022, you can see how those sectors outperformed the overall market. As we look at valuations this year and going into the second half of the year, defensives could actually provide some stability in your portfolio as things start to get more volatile, as we start to look toward the election and also the slowdown potential in the third and fourth quarter. Duration. Duration is a measure of a bond's sensitivity to interest rates. Fed's current pause on interest rate represents an opportunity for investors to consider adding duration into their portfolios. Adding duration can lock in current higher rates for longer and potentially offer appreciation as interest rates start to drop in the future. As you look at this figure 1, Fed cuts are likely beginning in the back half of 2024. At the overnight rate right now, between 5.25% to 5.5%, you can see the path of lower interest rates over the next 6 to 12 months. And the potential Fed interest rate hike pause in historical bond performance has actually been very good. And the average return following the last hike, and this is going back to 1994 and looking at it through 2023, for core bonds has been 8.3% annualized, and short-term bonds at about 5.3%, and money markets at about 3.8%. So worldwide interest rates, the most aggressive global monetary tightening cycle in decades, has been in focus over the past few years. Global central banks that moved together to battle inflation are now starting to diverge. European central banks are turning dovish, and Switzerland and Sweden have actually started to cut rates. The US Fed has stayed cautious about cutting too soon. As you look at interest rates, looking from September 2021 to now May of 2024, you can see Switzerland and Sweden have made their first cuts. The Eurozone is expected to cut in June, and Canada and UK are soon to follow. The US will probably be more toward the back half of the year. This will actually play into the stock market returns and currency positioning as we go into 2025. Thank you for joining us for 3 and 3.